So as sir was mentioning that last time I showed a lot of data. So I hope that data also resulted in some conversion, right? So now I ask the same question. How many of you do or have started doing index funds? Although I showed a lot of data, but the outcome is not so attractive, right? Let's try again, right? Because this is the long battle between active and passive, so I think I have to fight again and again. So if you see, what is the objective of making this presentation, right? It is adding passive funds to your advantage, right? If we simply go to the discussion that we had in the previous conversation is that between the two investment philosophies that exist, active and passive, why active strategies are so popular? Tell me, why active strategies are so popular? The belief that they will outperform the market. The belief that they will generate alpha, right? What is the challenge of actively managed strategies? Sorry? It is actually discretionary risk. In an active scheme, a fund manager decides the portfolio, which means in any active scheme, a fund manager bases his understanding of the market, creates a story around that market, builds portfolio around that story. If that story works, then there is alpha. If that story does not work, there is no alpha, right? So consistency of performance is the largest issue faced by all the categories of actively managed schemes. We all agree to this? The ultimate truth is winners keep changing. Now, if I may ask, mid-cap, actively managed mid-cap is a very big category. Close to 4.5 lakh crore assets are there in that category. As on today, if I go and check last 1 year return, what is the difference of return between the best performing scheme and worst performing scheme? Any of you? What is the difference of return between the best performing scheme and worst performing scheme? Sorry? 5%, 10%, 10 to 15%. Any answer from that side? 14%. If I say that number is 25%? Yes, that number is 25%. So we will simply see that the disadvantage of actively managed scheme, how we can turn that disadvantage to our advantage by simply adding some allocation to passive schemes, right? Now, if we go and dig into this category, like there are 328 ETFs in this category, 362 index funds, total assets of roughly 14 lakh crores, total 6 crore kind of a folio, an industry which is growing at a CAGR of 36% for last 5-6 years. Within that, if you see the index fund, which is actually a solution that you can offer to your investors, it is growing at a CAGR of 75%. Now, if you are not selling that, which means you are actually losing on a category which is growing at a CAGR of 75%. Very big number, right? Within that also, when we talk about index fund, it comprises of equity index fund and fixed income index fund. Now, if you see equity index fund, which was hardly anything last 5 years back, 17,000 crores is now 2 lakh crore, which means more than 65% CAGR growth in a category which you are not selling. So there is a need for you to start doing this. Now, let's do some number. As sir was just saying that I show a lot of data, let's now dive into the world of data. Before that, we have to do this active passive debate, right? As I was mentioning. Now, let's go and see what are the categories of active scheme and what is the money being chased in each category. You can see that the sectoral is the largest, followed by flexi cap, mid cap, large cap, small cap, large and mid cap. So primarily, if you see diversified core categories are what? Flexi cap, large cap, mid cap, small cap, and large and mid cap. And that comprise your core allocation that you make core allocation for your investors. Is that right? Across all these 5-6 categories, you make core allocation for your investors, which is 60% of the total assets of actively managed equities. If we go and check all these 6 categories, which is 60% of the total assets, right? Let's start with large cap. Large cap, which is close to a 4 lakh crore kind of a category. If I go and check as on 30th April, last 5-year return, as on 30th April, 5-year return, and if I go and check, the average return delivered by actively managed large cap scheme is 11.7. You can see that? What is the minimum return generated by actively managed large cap scheme? 8.2, maximum 17.1. What is the difference between the minimum and maximum? 5-year CAGR, close to 9%, which is as good as that you are investing 1.5 into fixed income. Considering 6% yield of fixed income, if the differential is 9%, which means you are actually losing 1.5 of fixed income. Correct? Same thing if you see for mid cap, the average return is 17.9. The difference between the best and the worst performing scheme is close to 10%. If you go and check the same thing for large and mid cap, you can see that the difference is 11%. If you see for small cap, the difference is close to 8%. If you see the flexi cap, which is again a very large category, that difference is close to 13%. And this is 13% CAGR difference between the best performing scheme and worst performing scheme. Now tell me, what is the possibility that you always select the scheme which is best performing? Possible? What is the possibility that you always end up selecting a scheme which is worst performing? Possible. Because what happens is, we as an industry, we always try to go and chase only one thing, which is return. Funds, most of the funds are being selected on the basis of their past returns. Now, a fund which has already delivered return, which actually completed 60% of its trajectory, and after that you have selected the fund. Because the price momentum of any market will be like this. It will never be straight line like this. Now, in each category, if I actually show you the index performance, like in large cap, the index is Nifty 100. The average return delivered by large cap is 11.7, while if I go and check the same return for Nifty 100, that is 12.2, better than average. Similarly, if you see for mid cap, 17.9 versus 20, better than average. Again, large and mid cap, 15.1 versus 16.2, better than average. Same thing with flexi cap, 13.3 versus 14%, Nifty 500, better than average. Right? So do you think that there is a need for adding passive schemes to a certain extent to your portfolio? Because if you are simply adding a market cap index to your investors' portfolio, what you are actually getting into, you escape that trap of being into best performing and worst performing, and you are closer to average. And sometimes good enough is very good. Right? Now, if we go and check category wise, let's go and see for large cap. What I have done is I have plotted financial year wise return after the period of categorization. Categorization happened in 2018. So from 2018 till 2026, if you go and check the schemes which are there in the actively managed large cap category, what I have done is I have highlighted green as top 5 performing schemes and red as top 5 worst performing schemes. Right? The top 5 and the bottom 5. You can see that the schemes move from straight away top 5 to straight away bottom 5. So the scheme which is a winner now will be the worst performing next year. Again, in that, you always have the pursuit of keep chasing the winner again and again, and that is always a trap. Same thing, if you go and check for mid-cap category, you will see the same answer. Right? The best performing scheme and the worst performing scheme keeps on changing financial year wise. Same thing you see for large and mid cap category, same thing you see for small cap category, and same thing you see for flexi cap category, which is a favorite category to most of the distributors. Am I right? Flexi cap is a favorite category to most of the distributors. And see, in flexi cap category also, winners are changing. Every financial year, winners are changing. And I've also given the name of the schemes. This is full transparency. Now the question comes is that you are showing me financial year wise return, while whenever we make investments for the investors, we always say that you please come for a 5-year investment horizon, right? So for that matter, what I have done is, I have done a 5-year daily rolling returns, because daily rolling actually gives you the consistency test also. So if you go and check for large cap from 2018 till 2026, based on daily rolling 5-year return with close to 1250 observations, 74% time the Nifty 100 has outperformed actively managed large cap schemes. Which means whenever you are allocating large cap schemes for your investors, there is only 25% probability that you will outperform the market. Same thing is with mid caps. If you see mid caps also based on 5-year daily rolling return, 74% time mid cap 150 is outperforming actively managed mid cap schemes. For large and mid cap, again that number is 78. For small cap, that number is very less, 39%. And for flexi cap, that number is 63%. Right? So what is the solution that I'm offering? See, after seeing all these data, what is that we should do in this direction? For large cap, you should do some allocation definitely to index funds. Because if 74% time when index is outperforming, then there's absolute sense that you do some allocation in large cap category to index funds. Agree on that? Same thing with mid cap, same thing with flexi cap, same thing with large and mid cap. But for small cap, please go only for actively managed small cap schemes. For small cap, I will not suggest you to go and invest in small cap index fund because the probability there is very low. Right? Now, what is the possible solutions there? For large cap, what you can do? I said large cap you should start considering an index fund, but what you should do? The approach is very clear. In large cap, where an investor is conservative, simply put 15-20% allocation to Nifty 50 index fund. If the investor is little moderate, put a 50-50% allocation to Nifty 50 and Next 50. If the investor is aggressive, put 60% Next 50, 40% Nifty 50. Simple. With that combination, you will actually tend to beat 80% time the actively managed large cap schemes. And that is a very good number. Same with mid cap. If I go and check for mid cap category, what you can actually do is invest 15-20% of your mid cap exposure to two strategies where I can suggest here is either go for a plain vanilla mid cap 150 index or go for a mid cap momentum. Remember, we have discussed mid cap momentum, a strategy that actually outperforms actively managed mid caps more than 90% times. For flexi cap, you should do some allocation to say Nifty 500. That's the entire market. For large and mid cap index, there is one index and that's a new to the industry, which is large and mid cap 250 index. So, lot of distributors actually say us that we don't want to give multiple schemes to our investors. Suggest me only one scheme or maximum 2 schemes in this category. I want to position index fund, but I cannot put 10 schemes in that category. Suggest me only 1 or 2 schemes in the index fund structure. So the 2 schemes that I want to suggest here is one, large and mid cap 250 index. That actually takes care of your large cap exposure, Nifty 50, Next 50, mid cap 150, everything bundled into one product, which is large and mid cap 250 index. Now, if you go and check the large and mid cap 250 index, it gives you exposure to 100 stocks of large cap and 150 stocks of mid cap in a way that 50% exposure will be given to large cap and 50% exposure will be given to mid cap. Over the above, if you see, this index also does quarterly rebalancing between large cap and mid cap, which means every quarter it will align 50-50 exposure to large cap and mid cap, which ultimately entails to auto profit booking on the upside and auto averaging on the downside. And as a result, if I compare based on 3-year, 5-year and 10-year rolling return, Nifty large and mid cap as compared to say Nifty 50 or a Next 50 or Nifty 200 or Nifty 500, you can see a clear 2% kind of an alpha. Now, if you remember, while we were seeing large cap returns, 5-year daily rolling large cap returns, What was the average return delivered by large cap? 11.5%, actively managed large cap. Here that number is 14.67. So simply by considering a market cap index fund, you are generating 300 basis point kind of an alpha, and that's a very, very good alpha. Yes, this is the only fund which does rebalancing between large cap and mid cap on a quarterly basis. So if you actually see, this fund considers three aspects. First, exposure to large cap. Second, exposure to mid cap. And third, it is equal weight. Not with stocks, but with market cap. 50-50. And that is why, by simply putting a simple market cap strategy, you are generating 250 to 300 basis point kind of an alpha as compared to actively managed large cap schemes. This is an index fund. This is an index fund. There is an index created by NSE, which is Nifty Large and Mid Cap 250 index, and we as an AMC are simply replicating it. But see the merit that it is bringing to the table. On 10-year, on 5-year, or on 3-year rolling returns basis, it is generating 250 to 300 basis point kind of an alpha by simply coming to a market cap strategy. No factor, no exotic product, a simple strategy that is generating 300 basis point kind of an alpha. You guys agree to this structure? आवाज नहीं आई. So that was actually a proverb, आवाज नहीं आई. Right. Now, if you actually see the structure, with simplicity you are generating returns. The second structure that I would like to highlight to all of you is a mid-cap momentum strategy. Remember we discussed a mid-cap momentum strategy? It is a strategy that picks 50 stocks on the basis of price momentum within the universe of 150 companies. Right? Now, if I am picking a 150 stocks out of the universe of 150 companies, essentially I am doing a stock selection. And it should be compared to an actively managed scheme, because in an actively managed scheme, a fund manager is picking the stock, whereas in this strategy, a machine is picking the stock, basis a certain formula. Right? So while I am doing a mid-cap momentum kind of a strategy, I have two primary objectives. First primary objective is that mid-cap momentum should outperform the universe mid-cap 150. Right? And the second is that mid-cap 150 momentum 50 should also outperform the actively managed mid-cap schemes. If it is serving both these objectives, I think there is a clear case that you should start some allocation of your mid-cap to mid-cap momentum kind of a strategy. Right. Now, if we go and check the long-term performance of mid-cap 150 versus mid-cap momentum, you can see that long-term 20 years CAGR of mid-cap 150 is close to 17%, whereas the same return, the same period return for mid-cap momentum is close to 23, close to 6% kind of a alpha. At almost similar standard deviation, a much higher risk-adjusted return at a lower beta. What else you need? Right? Now, when we talk about a passive strategy, in the beginning of the conversation, I told that the biggest challenge of actively managed scheme is consistency. There is lack of consistency, and that is why we should take a passive route also. Right? So what we actually need to check is the consistency test. Now, when we talk about, say, investment period, investment horizon to our investors, what is the minimum investment horizon that we portray to investors? 5 years, but minimum is 3 years, preferably 5 years, but minimum is 3 years. So what we have done is, we have computed a 3-year daily rolling return for mid-cap 150 and momentum 50 for last 21 years. And what you can see is that mid-cap momentum is outperforming mid-cap 150 in almost like 90% time. You can see 89% time with 7% kind of an alpha. Tell me an active scheme which has this kind of consistency. Right. The moment you go and check the same data for 5-year daily rolling return, what you can see is on a 5-year daily rolling return, mid-cap momentum is outperforming mid cap 150 100% time, and that too with an average alpha of 6.5%. While we were seeing the data for actively managed mid cap, on an average basis, mid cap 150 was beating actively managed mid cap schemes. This is beating mid cap 150 by 6.5% kind of an alpha. See the kind of proposition that we are trying to offer to you. Correct. Now coming to the second point, how this strategy is compared to an actively managed mid cap schemes. Right? So when I talk about say actively managed mid cap scheme, may I know 3-4 popular schemes in that mid cap category? Edelweiss. Thank you, sir. Other than Edelweiss? ICICI. And White Oak is a very recent one. Let's talk about those who are there for 6-7 years. HDFC is 1, Edelweiss is 2, Nippon is 3. There are no Kotak fans, right? Sundaram, right? Now let's see this comparison of active versus actively managed mid cap versus mid cap momentum. Now, if we want to do this comparison, we should ideally do this comparison from 2018 onwards because that's when categorization happened, right? So, if you see from a categorization perspective, I have taken data from April 2018 till April 2026, right? When we are analyzing the data, I think 1 year data analysis is waste. So that's why I have taken 3-year daily rolling return for last 8 years, and there are 1250 observations of 3-year period. Now, if you simply focus that the minimum 3-year return of mid-cap momentum is what? 14.4. And you can actually see the data that what is the minimum 3-year return by all the actively managed mid-cap schemes. HDFC is 6.7, Kotak is 11.2, Nippon is 10, Motilal is 6.2, Axis is 11.8. None of them are even closer to 14%, which means it has a very good drawdown. From a minimum return perspective, it is a very good drawdown. Now compare it from average return. While the average return of mid-cap momentum is 30.3, what is the average return of category? It is 22%. That's very, very important to note that it is actually protecting you from drawdown. At the same time, it is giving you a very good high average return. Now, if you go and check from a consistency perspective, right, that what is the percentage of time an HDFC mid-cap has outperformed mid-cap momentum or mid-cap momentum has outperformed HDFC mid-cap. So if you go and check the data, out of 1250 observations, mid-cap momentum has outperformed HDFC 75% time. In 75% time when it has outperformed, the average alpha it has generated is close to 7%. In 25% time when it has underperformed, the average underperformance is only minus 1.4. See, 1.4, 2% kind of underperformance can be digested if you are bringing 7% kind of a alpha in good markets. Now, again, the second popular scheme is Kotak, right? Kotak, it has outperformed, mid-cap momentum has outperformed Kotak 100% times. That too with an average alpha of 6.5%. Third, Nippon, if you go and check Nippon, some people were telling about Nippon also as a popular scheme. It has Nippon, mid-cap momentum has outperformed Nippon 85% time with close to 6% kind of an alpha. Edelweiss, 89% time. Mid-cap momentum has also outperformed Edelweiss actively managed mid-cap 89% time out of last 1250 observations. So I'm not sparing my scheme also. This is about category, right? So now, if you actually see that there is a proper sense where you should add these passive schemes, and what we should essentially use is the core and satellite approach, where core part of portfolio, you should continue investing into actively managed scheme, where you apply your skills, identify the scheme which is tend to outperform, and for the satellite, which is 25 to 30% of your portfolio or investors' portfolio, should go to these passively managed schemes. And I have given you two very simple solutions. For large cap, just go for large and mid cap 250 index. For mid cap, go for mid cap momentum. I think just by adding two schemes, you are actually creating the full effect of passive advantage in an investor's portfolio. So I hope then whenever I come next time for this kind of a session, I will see more hands, right? Because whether you start it or not, people are actually starting. I travel pan-India, and when I meet distributors, I think more than 300 crores of AUM wala investors, 75% of them have started with 20% allocation to passive schemes. It is just the time that you are killing. Because the kind of education that is being promoted in this category, Geo has launched a lot of index funds and they are promoting it big time. Now the question will come from investors that why you are not adding any index fund just because they are low on commercials. So let's not go that road and start allocating to strategies that will meaningfully add to investors' portfolio. At the same time, it will also be a very, very good client acquisition strategy for all of you. Thank you. This was all from my side. If there are questions, I'm more than happy to take. Thank you, everyone. When it comes to factor-based investing, it is actually a bridge between active and passive. Because the intent is to outperform the market without taking any discretionary call. But the behavior of factor also changes with market dynamics, right? And in a short period of time, you will not be able to reap the benefit of that behavior. Like for example, momentum. It is the most popular factor, but because of recent underperformance, people have stopped taking it. This is the time to take momentum, because when it comes to momentum, you should come with a minimum investment horizon of 5 years. And we have seen that data in a 5-year period, it is outperforming the broad index 100% time. But you have to be patient, right? It needs some sort of consistency to deliver return. Like if you see everybody is so gung-ho about value because value have delivered return for 5 years. But does that mean that it will continue delivering return? No. So one thing we should stop is chasing returns and follow the discipline of investing, which is equity, 3+ year investment horizon, preferably 5 years.
We can take one more question.
Sorry? So if you actually see last 1 year comparison, between all the factors, value is a factor that has outperformed all the actively managed schemes. Last 1 year return of value is close to 23%. Tell me an active scheme which has done that. But it is not possible for you to identify that value will perform, so I'll take exposure in value now. You see, that is the reason I say that seeing 1 year return is only satisfying your ego that, yeah, I'm actually investing in a scheme which has delivered 1 year good return. It should follow with a certain discipline that if I like that approach, if I like the consistency of that approach, if I'm convinced with the construct of the approach, then my minimum investment horizon is 5 years. So 1 year data can be very, very misleading. Like I'll give you an example. There is a scheme which was the best performing scheme in the mid-cap 6 months back, right? And that used to generate 10% alpha over mid-cap 150. The same fund is now generating 10% underperformance against mid-cap 150. So 1 year return can be very, very misleading. My suggestion would be never go and check 1 year data. Stick to the discipline of equity investing, which is minimum 3 year, preferably 5 year. Yes, sir. Now, if you actually see next 50 now, despite being part of large cap, its behavior is very similar to mid cap, right? Because they are like incubator to Nifty 50. That is why it is very, very volatile. Like if you go and check next 50 1 year return today, it is outperforming Nifty 50 by 10%. 10% alpha over Nifty 50. And the same data, if you go and check 6 months back, you can see that next 50 was underperforming Nifty 50 by 12%. So yes, next 50 is a good index, but you have to tactically play it. So whenever next 50 starts underperforming, increase your allocation to next 50. And the moment you see 5-7% kind of alpha of next 50 over Nifty 50, stop using next 50. That's the best approach to use next 50 as a tactical call.
Thank you, sir.
Thank you.
For explaining so nicely about fund selection between passive and active. Please stay on the stage. I request Mr. Singaravelan to come and honor Mr. Ankit Singhania.